financial innovation has never been a smooth ascent toward efficiency. It has been a series of jolts delivered by necessity, fear, ambition, and occasionally hubris. When I look across the centuries, I do not see clever inventions emerging in calm rooms. I see systems under strain, searching desperately for new ways to move, value share risk, and postpone constraint. Financial innovation is not the art of making money smarter. It is the survival instinct of economies confronted with limits. Each innovation answers a problem of its time, and in doing so, quietly creates the problem of the next era. The earliest financial innovations emerged not from wealth, but from scarcity. In ancient Mesopotamia, long before coins circulated widely, merchants developed credit interest and forward contracts because barter could not sustain long-distance trade. Clay tablets recorded debts in grain and silver, not as abstractions, but as survival tools. A farmer needed seed before harvest. A trader needed goods before sale. Credit filled the gap between present need and future production. This was finance in its purest form, trust formalized to overcome time. From the beginning, innovation in finance was inseparable from belief and enforcement, from temples, palaces, and later courts that guaranteed contracts when personal trust failed. Coinage itself was a revolutionary financial technology, not because it introduced money, but because it standardized trust. When Lydia stamped metal with the authority of the state, value became portable, divisible, and comparable across markets. This innovation accelerated trade and taxation simultaneously. Empires learned quickly that controlling money meant controlling economic life. Yet even here, innovation carried danger. Debasement-altering metal content while preserving face value was an early form of financial engineering, one that solved short-term fiscal problems while sowing long-term distrust. The pattern was set: early innovation expands capacity, then tempts abuse. The medieval world refined financial innovation under constraint. With religious prohibitions against usury, merchants developed creative instruments to disguise interest partnerships, bills of exchange, currency arbitrage. Italian city-states became laboratories where finance adapted faster than doctrine. Double-entry bookkeeping emerged, not merely to track profit, but to discipline behavior and plan the future. It transformed commerce by making loss as visible as gain. This was a subtle but profound innovation. Once risk could be measured systematically, it could be managed, shared, and eventually sold. Public debt was another innovation born from pressure. As wars grew costlier, states learned to borrow systematically rather than plunder episodically. Government bonds transformed future tax revenue into present power. This innovation stabilized states capable of honoring promises and destroyed those that could not. The Dutch Republic and Britain demonstrated that credible institutions were themselves financial technologies. Trust became infrastructure. This lesson echoes still. Markets lend cheaply to those they believe will restrain themselves. The 19th century industrialized financial innovation. Banks expanded credit to fuel factories and railways. Insurance transformed catastrophe into calculable cost. Futures markets stabilized prices across time. Each instrument reduced one form of uncertainty while introducing another. Railways could be financed, but over-financed. Insurance spread risk, but encouraged carelessness. Futures hedged volatility, but invited speculation. Innovation never eliminated risk. It redistributed it, often invisibly. When panics arrived, as in 1873, they revealed how tightly innovation had bound systems together. The 20th century elevated financial innovation into policy. Central banking, fiat money, and macroeconomic management emerged not from theory, but from crisis. The Great Depression forced states to innovate, defensively deposit insurance securities, regulation, and counter-cyclical spending. After World War II, new institutions, IMF, World Bank, Bretton Woods, attempted to stabilize global finance through coordinated innovation. These were not neutral improvements. They embedded power structures and priorities into the architecture of money. Financial innovation became geopolitical. Late in the century, finance entered its most abstract phase. Derivatives, securitization, and quantitative models promised to slice price and disperse risk with mathematical elegance. For a time it seemed to work. Volatility fell, credit expanded, returns smoothed. Yet history had seen this calm before. Complexity replaced transparency. Risk migrated into shadows. The crisis of 2008 was not a failure of innovation itself, but of belief in innovation as substitute for restraint. Once again, tools designed to manage uncertainty amplified it when assumptions failed. Across all these centuries, a consistent rhythm emerges. Financial innovation appears when existing structures cannot handle new scale or stress. It expands possibility and postpones constraint. It creates winners who celebrate progress and skeptics who warn of fragility. Eventually, its limits are exposed through crisis, and the system either adapts or collapses. Innovation is neither hero nor villain. It is catalyst. What is often forgotten is that financial innovation shapes behavior as much as outcomes. It changes how people think about time, risk, and responsibility. When losses can be transferred, risk-taking increases. When futures can be hedged, leverage grows. When rescue is expected, caution erodes. History shows that innovation without memory produces cycles of excess, while innovation constrained by institutional humility produces stability temporarily. And it is here at the edge of our own era of digital finance, algorithmic markets, and decentralized promises that the long history of financial innovation becomes most relevant, because the question has never been whether innovation will continue, but whether societies will remember that every new financial tool is also a moral choice about who bears uncertainty, who absorbs failure, and how much fragility is being quietly stored for the future when the next test arrives and the story moves toward that price. Because every era eventually discovers that financial innovation cannot outrun human nature, only postpone its reckoning. As finance has moved into the digital age, innovation has accelerated beyond anything previous centuries experienced, yet the underlying pattern remains uncannily familiar. Technologies change the surface of finance, not its psychology. Algorithms replace clerks. Blockchains replace ledgers. Platforms replace banks. But the fundamental question endures: does innovation serve to distribute risk more wisely, or to disguise it more elegantly? In the early 21st century, financial innovation has been driven less by scarcity than by excess, liquidity, excess, data, excess speed. Fintech promised inclusion and efficiency, reducing friction and expanding access. For many, it delivered real benefits: faster payments, cheaper credit, broader participation. But history urges us to look beneath the convenience. Each reduction in friction also reduces reflection. When money moves instantly, mistakes compound instantly. When credit is automated, judgment is embedded in code, written by those far from consequence. Innovation once again solves yesterday's bottleneck while quietly creating tomorrow's vulnerability. The rise of decentralized finance and digital assets reflects an even deeper historical impulse: the desire to escape institutional failure by redesigning trust itself. This impulse is not new. It echoes medieval merchants bypassing usury laws, 19th century investors fleeing unstable states, and 20th century savers seeking refuge from inflation. Each time innovation promised autonomy and safety. Each time new concentrations of power emerged, often faster and less accountable than those they replaced. History teaches us that removing intermediaries does not remove hierarchy, it relocates it. What distinguishes durable financial innovation from destructive novelty is not brilliance, but restraint. The most successful innovations in history, insurance joint stock companies, central banking, were eventually surrounded by norms, rules, and limits that acknowledged human fallibility. They survived not because they were perfect, but because societies learned where to stop. Innovation that refuses limits invites crisis. Innovation that accepts them becomes infrastructure. This is the dividing line history draws repeatedly. Another lesson emerges with clarity across centuries. Financial innovation always outruns regulation at first, but regulation eventually catches up, usually after damage has occurred. This lag is not a failure of intelligence. It is a feature of complex systems. By the time risks are visible, they are already embedded. The danger arises when innovation is celebrated as inherently virtuous, immune to the lessons of the past. History does not condemn innovation. It condemns amnesia. Looking across the long arc, financial innovation appears less as a march forward than as a spiral. Ideas return in new guises, refined by technology, but animated by the same motivations to borrow from the future, to insure against uncertainty, to convert belief into profit. Each cycle expands capacity, then tests legitimacy. Each crisis narrows imagination temporarily, only for creativity to re-emerge under new constraints. This is not failure. It is the evolutionary rhythm of finance. The enduring question, therefore, is not whether innovation should be encouraged or restrained, but whether societies can remain honest about its trade-offs. Innovation always answers one problem by creating another. It always shifts risk rather than eliminating it. And it always raises the same moral choice: who benefits first and who pays last. History shows that when these questions are ignored, finance becomes brittle. When they are confronted openly, finance becomes resilient, if only for a time. If this journey through centuries of financial innovation has sharpened your understanding of today's markets and technologies, I invite you to subscribe and continue these explorations with me, and to leave a comment, sharing which financial innovation you believe most clearly embodies both promise and danger. Because history does not ask us to fear innovation, only to remember that every new financial tool is a mirror reflecting not just our ingenuity, but our willingness to confront uncertainty with humility rather than illusion.